service company? Well, for the service company, what we can do is we can follow the same format. The only thing is on the service company, since we're not manufacturing, we're not going to have a product cost. That's the whole thing. That's the whole thing. Otherwise, everything else will be the same. So for the service company, again, no products because we're not producing anything. We're just providing the service, but there will be inventory. And in that inventory, you can also have variances. Example for the service company can be cleaning company, which using some supplies, can be automobile repair shop. That's a service company, which also gonna use some parts, but they're not producing the parts. They're not manufacturing. For that reason, there will be no direct material involved. However, there will be direct labor, and obviously will be manufacturing overhead. Every company has manufacturing overhead. Every company which provides service or produces product, every company which provides service will have manufacturing overhead. They have to. They're going to implement that manufacturing overhead in the cost of the labor or that they charge it to the client or some other means of the cost in order to recover that cost. Otherwise, you're never going to see profit. And again, the whole idea that you open companies to see profit, not profit, you want to see cash, because most of the time profit it's not equal to cash, as you already know from financial reporting. Income is income, revenue is revenue, profit is profit, but cash is cash. So that brings us to, since we did the direct variances for direct material, variances for direct labor, variances for manufacturing, variable manufacturing overhead, let's see how we're going to deal with the fixed manufacturing overhead. That will be the key here, the fixed manufacturing overhead. Now, before we go to the fixed manufacturing overhead, let's think about it, how in the normal company, in the job costing, that was chapter 5, how we calculate that predetermined overhead rate. For the predetermined overhead rate, if you still remember, we using the estimated total cost for the upcoming period. And as a denominator, we're using the level of activity, which drives that cost. So now we're going to choose allocation base, which we're going to use as a denominator level of activity, but preferably that allocation base should drive the cost for the overhead. Once we can get the total cost as a nominator, activity as a denominator for the same period, we're going to come up with a predetermined manufacturing overhead, which predetermined manufacturing overhead we're going to use to assign overhead to our product. What was interesting, again, the denominator of activity is the allocation base, which is used to compute that predetermined overhead rate. And once we calculate that predetermined overhead rate, we don't change it during the year. If we have to change it, we're going to wait for the entire year to pass, and before we start the new period, then you're going to change it. Now, I don't know if you haven't experienced this. When is the calculation for the predetermined overhead? Because it's a very tricky part, very tricky point. And you as an accountant, if you're actually doing actual accounting, you don't have much time to think about this. So you have to be proactive in actually think during the period, before the period comes to the end. Otherwise, you're going to have problem to calculate that predetermined overhead. And as I said, every company should have. I know most of the company don't have. Most of the service company, they don't have that one. But that's their problem. Let them be. I'm telling you, there's so many businesses that somehow they're making money. And as long as they're making money, they don't do any calculations, neither for direct material, neither for direct labor, neither for the manufacturer overhead, nothing like that. They know I'm making money. Why I'm making money, I don't know, but I'm just making money. End of the story. Clients paid me. I'm charging the revenue, like a markup. I'm marking up my products. I feel happy, right? That's on the bright side. But on the negative side will be, what if something goes wrong and you start losing the clients? What will happen then? Now, that predetermined overhead, once we calculate it, we're going to break it by two parts. One part will be the variable component of that manufacturing overhead, and the other one will be the fixed component of the manufacturing overhead. Now, the variable component, we're going to use it to analyze the variable manufacturing overhead variances, but the fixed component, we're going to use it to prepare and analyze the fixed overhead variances. Before we do that, let's go a little bit explanation about the costing system that we're running in the reality. There are two types of costing system. One, you have to run no matter what you're doing. The traditional costing system, you have to run it no matter what. Why? Because that's the only system, costing system, which is allowed by International Financial Reporting Standard, accounting standard for the private enterprises. So the company has to have traditional costing system, which traditional costing system using predetermined manufacturing overhead rate to assign the manufacturing overhead to the cost of the product or cost of the services in the company for calculation of the final product. That will come on the financial reports. It's going to add to the cost of goods sold or the cost of the service delivered, and you're going to have that gross margin. And as you know from the financial reporting, you want to separate all the main activity of the company. So you want to separate the revenue expenses related to the main activity of the company and to see how profitable is that activity, and then to have all the other expenses which are supporting expenses to the main activity, which are cooperating expenses. So that will be your traditional system. On the other hand, you have activity-based costing. Activity-based costing is more complex, more expensive, more effort you have to put, but it's going to give you a benefit that traditional cannot give you that. We already talked about it. But those are the two systems that can run. So regardless if you run activity-based costing, you still have to run the traditional. Because as we said, the activity-based costing is supplemental system to the traditional costing system. Because activity-based costing is not it's not recognized, it's not allowed by International Financial Reporting Standard, accounting standard for the private enterprises. Now, since we know this, let's go to traditional system. Now, the traditional costing system, which have using that predetermined overhead, we have two costing systems. One is the normal cost system, which overhead is applied to the working process based on the actual number of hours or actual usage of the allocation base, which we're using to calculate predetermined manufacturing overhead. And then we have the standard cost system, which the overhead now is applied to working process based on the standard hours, which are allowed to the actual input of the period. I want you to see this difference clearly. Imagine this. We have employee who producing what they're producing. Cell phones. So in the normal costing system, let's say employee work 8 hours per day. So what we're going to do in the normal costing system, we're going to 8 hours actual hours work time the predetermined overhead rate, let's say $10, and we are assigning the overhead to our products. Whatever they produce during the day, we are assigning that 80, so 8 hours times $10. We are assigning those $80 and we're done. Now the standard cost system is different. In the standard cost system, we're gonna see, okay, they work 8 hours. That's fine, but I don't care about that. That normal cost system dealing with actual hours. We're chasing how many products they produce within those 8 hours. Let's say they produce 5 cell phones. Now, for those actual cell phones that they produced, what's the standard of the direct labor allowed to produce one cell phone? Let's say for every cell phone, we need 2 hours. Then what we're gonna do, we're gonna use 5 cell phones time 2 hours, 10 hours, 10 hours time $10 manufacturing overhead, and we're gonna assign the manufacturing overhead to our products. So as you can see, in this case, in the normal system, our manufacturing overhead will be less than the standard costing system, which using the standard hours, which are allowed for the actual input for that period. Again, T account on the left side always going to have the actual overhead which happened during the period. On the right side, you're always going to have, first thing that you're going to have, definitely going to have predetermined overhead rate in both systems. Now, on the normal costing system, we're going to use the actual hours or actual usage of allocation base or actual usage of denominator activity, where in the standard costing system, we're going to apply overhead by standard hours, which are allowed for the actual output time predetermined overhead. And at the end of the period, again, we're going to have either over apply or under apply overhead. So having that in mind, now we can talk about the variances on the fixed overhead. We're going to have actual overhead at the end of the period. We're going to have budget overhead, and we're going to have fixed overhead applied. What's different? Actual is actual. The budget is the one that we're using to prepare our budget and to come up with our predetermined overhead rate. The overhead applied will be based on the standard hours allowed to achieve the actual activity. So the denominator hours will be used for the budget. Standard hours allowed for the production we're going to use in the fixed overhead applied. And the standard fixed rate will be the rate that we're going to use in both in the fixed overhead, on the budget, and on the applied. How are we going to interpret the differences? We're going to have budget difference between the budget and the actual, and we have volume difference between the applied and the budgeted. How are we going to interpret those differences? Again, the budget variance simply measures what's the actual difference between cost that we're expecting on the budget and the actual cost. That's all. The volume variances will be the tricky part. The volume variance is going to show us how good we are on utilization of our capacity. So if we have to prepare this analysis, one thing we have to keep in mind is that variable overhead rate per hour here, it's always the same. Variable overhead per unit is always the same. Total fixed cost is always the same. Now, having that in mind, what will be the variable overhead rate if we're using the machine for 3,000 hours and the total variable overhead is $6,000. Obviously, 6 divided by 3, that's going to be $2 per hour will be the rate. If we use the machine for 4,000 hours, our cost would be $8,000. So again, variable overhead rate again will be $2. Total fixed overhead, regardless of the machine hours, always going to stay the same. Now, what's going to happen with the fixed overhead rate for 1 hour? If we're using the machine for 3,000 hours, our rate will be $3. 9 divided by 3. But if we're using the machine for 4,000 hours, our rate is going to go down. So the calculation, the variable overhead, it's always going to be $2, and the fixed overhead rate now per unit, as you can see, going down. More we're using the machine, less fixed overhead rate goes down. The both variable and the fixed going to give us our predetermined overhead rate. Now let's see the question here. Here we're going to have company which actual production require 3,200 standard machine hours. The actual fixed overhead was $8,400. Predetermined overhead rate is based on the 3,000 machine hours. So what we're going to do here? There are two options. Either we're going to go to the slides, either I'm going to flip this and move it to the Excel spreadsheet. Which one you prefer?
Excel.
Excel. Okay. If the customer wants Excel, we shall give them Excel, right? Let me find the proper Excel, which is going to increase the level of satisfaction. And once I have it, I can flip the information and we can start working on it. Okay, I have something here. Let me make another new Excel spreadsheet. I'm just going to copy the old one from the last time. I'm going to flip it to the new one. And now we can work on this one. Okay. Okay. Let's stop sharing this and let's move to our new Excel sheet, which will be this one. Now, that's what the variable overhead. We don't want variable overhead because we have fixed overhead. Fixed overhead. So on the fixed cost, on the fixed overhead, we're going to have actual. We're going to have here budget. And here we're going to have the standard. I'm not going to change the standard because that's exactly the standard. So the actual, we're not going to have those calculations. That's the beauty here. No calculations here. That variance is not going to be spending, it's going to be budget variance. And this variance is not going to be efficiency variance, it's going to be volume variance. And the overall variance is overall variance. So I don't need this information anymore. So here I'm going to have, let's do some, that will be the budget hours. And those will be standard hours here. So I can delete this, delete this, delete this, delete this. These numbers can stay and delete this one. All right, so now I can post the picture that I have from the PowerPoints about the information of this company. Let me see what you see. Yes, you see my screen. Perfect. Let's post it. And that's our question. Can you guys see the question?
Yeah.
All right. So let's
Yes.
start. Let's move those unfavorable. Let's see what's going to happen. Now, again, this company actual production required 3,200 standard machine hours. So the 3,200 standard machine hours is obviously right here. Right? That's our standard hours, which is required for the actual production. Now, the actual fixed overhead was $8,450. So $8,450 is our actual overhead. Now, the predetermined overhead rate, was based on the 3,000 hours. So what was the number of the machine hours that we're using to calculate our predetermined overhead? What was the budgeted hours that we use? 3,000 hours. So let's plug here 3,000 hours. Okay, so far so good, correct? Now we need more information. For where we're gonna get the more information? The more information, we're gonna get it from the slides. We're gonna go back and we're gonna see call, when they prepare the flexible budget, they come up. When they're using the machine 3,000 hours, what was the budgeted overhead? Can you see it?
I think it's $3.
No, the total cost.
Oh, sorry, it's 9,000.
9,000. Yes, the per rate is $3. Yes, you're right. The rate is $3. Total is 9,000. Let's go now to the Excel spreadsheet once we know that one for sure. And let's plug the numbers. Share this. Go here. And now what we're going to have here. Our rate, as your mouse said, is $3. And once it's $3, our budget overhead, fixed overhead was $9,000, correct? Now we're going to have our first variance, which will be equal to 9,000 minus 8,450, which is our budget variance, right? How much is our budget variance? $5,500, right? The question is, what kind of variance is this? Favorable or unfavorable?
It's favorable, right?
Favorable, yes, definitely is favorable. If you budgeted to spend $9,000 and you subsequently spend less than $9,000, that's in your favor, no questions about it. Let's see now the standard. Based on our standard, what will be that cost? We know the standard hours that we need to achieve the actual production. The standard rate is standard rate. That $3 is $3 here. So based on our standard, we're supposed to spend to achieve this production $9,600, which gives us another favorable variance, right?
Yes.
600 favorable. So the overall variance is, that's not going to be, it's going to be equal 9,600 minus 8,550, and that will be definitely will be now favorable. So we all favorable here. How are we going to interpret this? First, the budget variance, again, that's purely saving the money. The volume variance is something interesting though. Imagine, by my standards, I have the capacity of 3,200 hours, but I'm budgeting below my standards. Is that good for me?
Could you repeat that question, please?
So based on my standards, I have 3,200 hours available, but preparing my budget on the 3,000 hours only. Is that good for me or bad?
It means you're not working to full capacity.
That's exactly what it means. So for that reason, when you see the favorable variance here on the volume variance, is it actually favorable? And the answer is no. It shows you that how much you're missing from the available capacity that you still have, but you're not using. So imagine here, I have the because this is a fixed cost. Do you understand this? This is a fixed cost. So we paying this cost regardless. The example will be, you're going to Whistler. You're going to Whistler to ski for 1 day. You're paying $200 pass for 1 day. Make sense? Now, based on the standards of the lifts, of the waiting time, of the average ski amateur, you can do 12 runs. But because you're planning to go there a little bit late, there's a traffic, also you're planning to have a coffee before you start, and there'll be a lunch after, and then you're gonna have a snack and this and this. You're budgeting out of possible 12 runs, I'm gonna do 8. That's more realistic, right? And you start runs. You're running once, you're running 2, or you're running 3 times, you start getting tired. You say, okay, I'm gonna make one more 4 run, and I'm gonna take a lunch. You're taking lunch, you feel heavy, you're going for one more run, you're doing 5, and it's already 3 o'clock, and you're wondering, should I make another one? Should I not? And you say, oh, what the hell? I'm done for today. Did you utilize your cost for the ticket that you pay? That's the question.
No.
No. That's what those variances shows you. That's why I want you to understand that the fixed overhead variance is probably the key for every company to make more profit by moving to the top of the standards. Now, here comes another question, which is very tricky question, and most of the entrepreneurs missing this point. Now, working very close to the standard for the available to the capacity that you have, it's good thing because you're utilizing a fixed cost, and obviously you're running, you're making the most profit because you're utilizing efficiently that cost. So what those entrepreneurs doing? They're thinking that it's time for me to expand, and that's what they're making the biggest mistake. Why? Because they doubling the fixed cost, but their utilization rate is not even 50% anymore. Makes sense? On the previous relevant range, they're about 90, 95 utilization rate on the fixed cost. So they using a maximum possible of that fixed cost. And once they move to the next level because they want to expand, they're thinking that, hey, if I increase my if I increase my profits, sorry, if I increase my sales with 20% more potential, I have that potential, I have that demand from the market, I'm going to make more money. So let's expand. And 3 months later, they're out of the business. This is a very critical point. I want you to understand this point. Because most of the entrepreneurs, they cannot get it. And that's why from the very successful company, 3 months later, that company is out. Why? Because they expanded. They doubled their fixed cost. But they don't have potential to utilize that fixed cost and to make the fixed cost work for them. Okay, so now let's stop sharing this and let's move back to slides. Finish those slides and move to the next chapter. So again, budget variance, clearly budget versus the actual, no questions about it. Then we have the other variance, which is the volume variance, which give us the fixed overhead applied based on the standard hours and the budgeted that we call volume variance. The volume variance, that result when the standard hours allowed for the actual input different from the denominator activity. So what's the basic rule is? Remember, you have to picture this now. We have the standard hours and we have budgeted hours, which budgeted hours we're using as a denominator to calculate our predetermined manufacturing overhead. So how this works? As long as the standard hours allowed here, standard hours allowed are more than the budgeted, because we budgeted 3,000 hours, we're always going to have a favorable variance. The only way we to have a unfavorable variance is if we have 3,200 hours, but we budget for more than 3,200 hours. That's the only way we can have unfavorable variance. And unfavorable variance here, it doesn't mean it's a bad thing. And actually, unfavorable variance means that you're going above the standards. So the volume variance, does it measure over or underspending? Absolutely not. That result is only and only when we're treating the fixed overhead as if it's a variable cost. So let's go to this question and let's see. I'm going to copy this question. We're going to move back to the Excel spreadsheet. Stop sharing here and moving to Excel spreadsheet right here. I'm going to copy this sheet on the new worksheet. Get the question. Pose the question here, and we're going to work now together, see what we can get and what we can calculate from this question. So that's our question. Those numbers are useless at this point. Let's get rid of those numbers. And let's try to plug the new numbers. First, this company, actual production for the period required 2,100 standard direct labor hours. So that will be our standard hours, 2,100, because that's how much the actual production require. The actual fixed overhead for the period was 14,800. That's the actual, $14,800. The budget overhead was $14,450. So we have the first variance, which is minus this, and in this case will be favorable or unfavorable? Unfavorable, yes. We're planning this much, we're spending $350 more. Unfavorable, definitely. No questions about it. Now, the predetermined fixed overhead rate is $7. So this rate here is $7. And here is also $7. So what will be our volume variance now? We can easily see it. That will be 250 favorable. Because based on our standards, we have 14,700 cost, but we budgeting only for 14,500. So that brings us, what was the budgeted hours that we use as a denominator for the calculation, the fixed for calculation manufacturing overhead? We can easily see it, total cost divided by the rate. And we're gonna see that we budgeted only 2,064 hours. Let's see, is that, and change. We have the capacity of 2,100 hours, but we going below our capacity. We're more realistic. So first answer here will be, can we see our answer here on the budget variance?
It's a D and 100 unfavorable.
350, yes. So let's go now to the slides and see, it will be 350 unfavorable, that's correct. And the next question will be, what is the volume variance? We already calculated. What will be the answer here?
B.
B, that's correct. And B is the right answer. If we have to prepare the chart, it's gonna look the same thing that we did. Now, how can we interpret the results for the Cola Co? Now, their budget was $9,000 because they're planning to use the machine for 3,000 hours. In reality, they use it less. But they have capacity of 3,200 standard hours. So all this thing here is the opportunity of utilization, the fixed cost, which they missed it. Sadly, but that's what happened. The other way you to see this example is this. Imagine you're not a Douglas student, you study somewhere else, and you have to pay for the monthly pass for the SkyTrain, which is 2 zones. And for 2 zones, let's say you're paying, let me see if I can open here one slide. Let's create one new slide. Let's see for the new zone here, you're paying, how much you pay? Let's make it like this. You're paying $140. $140 for monthly pass. So the $140 is for the monthly pass. But you already know that the day trip from the opening till 6:30 is cost you, let's say, $3.50. So here you have the potential of usage based on the standards. Now you can make 40 trips. Make sense? Now, you planning this month, when you pay $140 for monthly pass, you're planning to go back to your home country for 2 weeks. So now you're gonna budget that you're not gonna go for 40 trips. There's no way you to use 40 trips. You budget take for 35 trips. That's your budget. In reality, you got sick and you still went to your home country. And the actual usage of the trip was you used the SkyTrain only 27 trips. Actual. Make sense? So let's see the cost of the 27 trips actual. 27 trips, the cost will be equal to 27 times 3.50. On the 35 trips will be, the cost will be 35 times $3.50. And the 40 trips will be $140. But it's going to be equal to 140 trips, 40 trips times $3 and $3.50. Make sense? Which one is the highest?
The 40 trips?
The 40 trips is the highest, right? That's our standard. Make sense? The 35 is lower. That's how we budgeted. We budgeted for 35 trips. And in reality, we use it only 27. So you can see how we have a favorable variances. Make sense? But is it actually favorable? Where do you want to be on the trips? In this scenario, how many trips you want to make with the $140 monthly pass that you pay?
The 40 trips.
If you ask me, I'm gonna make 50 at least. I'm gonna go crazy here. 40 trips is the minimum that I have to make. But in order to make it work for me, I'm gonna go above the 40 trips. Make sense? That's how you're gonna make that cost work for you. Not only I'm gonna make the trips, I'm gonna give it to my wife, that monthly pass, and she's gonna go too. So I'm gonna make 40 trips and she's gonna make a 40 trips per month. We're gonna share the same pass. This is utilization of the fixed cost. Do you understand now? So you have to somehow increase the standard, go above the standard in order you to get the full benefits of the fixed cost that you're paying. That's why sometimes you can see in one-bedroom apartment, 4 people living inside. By all regulation in Canada, they shouldn't be. But that's how you're saving on the fixed cost. That's how you make the fixed cost work for your benefit. Okay, so enough with this fixed cost. Now let's performance report and variance investigation. What we're going to do, first we're going to perform that report for the analysis for the variable and fixed overhead, for direct material, direct labor, and everything. After preparing the performance report, then the managers still have to decide whether the variances that have been calculated require further action. Because you might have some variances that you just want to move on. You don't want to investigate. Managers should consider the dollar amount of the variances and the size of the variances. So one interesting approach is this statistical chart, or called also plot variance data. From this statistical control chart, we can see that the 0 point is where we are satisfied. And then we're going to see where is the deviation. The standard deviation was something that it's okay because that's based on our standards. Everything above the standard deviation is the one that we have to pay attention to. That's why it's important you to understand the statistics. There are a few things on the statistic that you definitely have to understand. What is standard deviation? What's the mean? What's the average? All those things. And when you see the numbers, you can interpret the numbers. Otherwise, you have to rely and go to the chat GPT and say, hey, chat GPT, what is this? What is that? That's boring, right? Always to go and asking artificial intelligence for help. Come on. At the end of the day, we're the ones who creating the artificial intelligence. So at some point, the creator start asking the creation how to help him. That doesn't make sense. Not for me, at least. Now we're going to have two things. Again, on the capacity analysis, remember, we have theoretical capacity, which theoretical capacity is full production time, no wastage, nothing, 24/7, 365, no downtime, no wastage, nothing. Practical capacity is the one that happened to be more realistic number because with the operating capacity, less any unavoidable downtime. How the standard is going to help us? The standard cost create the management by exception, promotes economy efficiency. Working close to the standards, you are more efficient. Working more to the class to the standard, you utilizing on the fixed cost, you utilizing the fixed cost. Simplify the bookkeeping and enhance responsibility accounting. The downsides, they're always plus and minuses. You have to understand this. For those of you who are going to continue later and is going to start doing cases and something, there's always positive and negative. It doesn't matter how perfect the things look like, they're always positive and negative. The only time that you see something like a perfect is the time that you don't know anything about it. That's why people say the perfect people are the one that you don't know anything about it. Once you start knowing more about them, they become less perfect. So you have to be able to see the positive and negative. So the downsides on the standard costing is the standard cost report may be not on time. It might emphasize on the negative and that may create a negative impact on the moral. You may have invalid assumptions about the relationship between labor and outputs. You may misinterpret favorable variances. We see on the cost on direct material, we saw that the purchasing manager, he created the favorable variance, which turned out to be losing variance for the overall the company. Why? Because he bought cheap material which has no quality. Or the favorable variance on the fixed manufacturing overhead, which shows us that we don't utilizing the cost. Some people without understanding, they may see, oh, okay, I'm saving here, that's good for me. Next thing is emphasizing standards. May on that point you can forget about other important objectives, and continuous improvement is more important than meeting the standards. And that's it for this chapter. And that concludes that part 2 of the chapter 10.